I read your notes and you remain prudent and neutral. I just look at the narrative, and I saw it on Twitter. It's beautifully encapsulated. We have gone from recession to depression to euphoria in 100 days. The speed of this repricing, is that what causes you to be prudent and neutral in your allocation?
I think to some extent, yes, although we have seen that a lot of these extreme moves have become shorter and shorter, both on the way down and on the way back up. I think everything seems to be priced almost to perfection, so we don't like to chase this rally. And at some point, especially now that finally sentiment is turning much more bullish and the rally is broadening, there is this question of disappointment risk. So we don't really want to run after the rally. We completely admit that we probably aren't going to see much bigger lows just because you're seeing this broadening, because cash levels are still quite high, and because a lot of people missed this rally. So as we see some corrections, they're likely to be a lot smaller, but we just don't like chasing the rally.
Esty, great to speak to you today. I mean, some people use the argument of the cash levels being elevated and consensus bearish to actually argue that the rally is going to continue to some extent. But when you say that you don't want to chase the rally and that it's priced to perfection, equity markets, that is, are you talking specifically about the US or global equities?
There's definitely room for catch-up from global equities. We started to see that again in the last 2 weeks, more so from Europe than from the emerging markets. I think you do have to be a lot more selective in the emerging markets because some situations, despite recent performance like Brazil, remain quite tricky. And I think on a medium-term basis will be a lot trickier to look at. So there's room to catch up. But globally, you have seen, even if you look at the MSCI World, we're pretty much pricing in this V-shaped recovery, which may now be unfolding quicker than expected following Friday's jobs numbers.
Esty, one of the discussions we're having this morning in our stories on Bloomberg is about, are we perhaps underestimating the momentum? Yes, you had the jobs number on Friday, but the economic surprises from Citigroup are back in positive territory. You have the Haitian doubling from a February low. So the question is it still too early for you to move more to value and small caps over large caps, to junk over IG? So that rotation narrative, or is that something which gathers momentum for you as we get more evidence on reopening?
So we're more comfortable with the rotation, and we started that rotation in the last few weeks, more into Europe over the U.S., more into value stocks. We've been in some European financials for a number of weeks now. So we believe in this catch-up, in this rotation. We're still a little more cautious on high yield versus investment grade. And a lot of this, I think, is about the central banks and where they're going to have their preference, which segments they're going to support more, and the fact that we still don't really know what the default rate might look like in high yield. So you need to be even more selective. So if you're, an active managers, your portfolio managers, we think they can find the right opportunities, but more broadly, through indices, we're a bit more cautious on high yield. Within the equity markets, we have started that rotation, but we still haven't wanted to go too far overweight into equities for the time being.